Good afternoon. In this short presentation, I'm going to be arguing that there's an asymmetric risk to emerging market monetary policy in the run-up to and the aftermath of the September Federal Reserve policy meeting. Now, there's obviously been a lot of talk in recent months about, on the one hand, the risk of deflation, and on the other, the risk of asset bubbles being generated by ultra-loose monetary policy. But if we take a step back and look at emerging markets, the picture that emerges is somewhat different. Headline CPI inflation has actually been remarkably stable in emerging markets for the past 3 years, as the chart shows very clearly. To put it in context, since January 2012, a weighted average of emerging markets inflation has been in a tight range of between 3% and 4.3% year on year. That's a range of only 1.3 percentage points over 40 months. And incidentally, if we strip out Chinese inflation data from the chart, the picture doesn't really change very much at all. It's only when we strip out inflation data from Russia and Brazil that the picture changes more markedly. And I think it's appropriate to look at what happened to inflation outside of Brazil and Russia, two economies which have suffered great economic shocks in the past year and have seen sharp rises in inflation. The chart shows very clearly that stripping out Russia and Brazil, emerging market inflation has been on a consistent downward trend for the past few years. To put it in context, back in the summer of 2011, EM inflation was running at about 6% year on year. Today, it's running at a quarter of that, at around 1.5% year on year. So how have central banks been reacting to this disinflation trend? Well, by and large, between the middle of 2013 and the end of last year, most central banks were actually hiking rates, looking forward to decent global growth and expecting rising inflation. A number of central banks, particularly in Brazil, Russia and Turkey, were also hiking rates to protect currencies which were under fire and under pressure. There were a few exceptions, notably most of the Central European central banks and the Central Bank of Mexico kept on cutting rates during this period of falling inflation. When it became clearer that global growth was going to disappoint and was going to come in lower than expected, and when it became clearer that inflation was failing to rise, we saw central banks on the whole cutting their interest rates. That's including central banks in China, India, Russia, and Turkey. Only Brazil, and to a lesser extent the South African central banks, have hiked their policy rates year to date. So what's the upshot of all this? Well, simply put, emerging market central banks' real policy rate, that's the policy rate deflated by inflation, has actually fallen back, roughly back to the levels we had a year ago. But I think what's perhaps more interesting and perhaps more surprising is that real interest rates are still quite high by historical standards. Actually, real policy rates today are higher than they were in 2010, 2012, and on a par with where real rates were in 2006 and 2007, when arguably the world economy was far rosier than it is today. And again, if we strip out China from these calculations, the picture doesn't really change that much. We still see a recent fall in real interest rates, but interest rates in level terms are still historically quite high. That surprising fact, I think, is even more pronounced if we once again strip out Russia and Brazil from the equation. We can see that whilst there has been a fall in real policy rates in recent months, the trend seemingly is still an upward one. So where does that leave us going forward? Well, I think that for commodity currencies, there is a case for the central banks to keep real policy rates quite high. There's an incentive for these central banks to keep policy probably tighter than they would want it to be in order to protect their currencies. I also think that emerging market central banks as a whole have been reluctant to cut rates faster or sooner because ultimately they expect the Federal Reserve to start hiking rates. And they are concerned that if they started cutting rates too soon, that would widen interest rate differentials with the US, which would in turn lead to FX outflows from emerging markets, which would finally put pressure on emerging market currencies. Having said that, I think that importantly, we face an asymmetric risk in terms of monetary policy in emerging markets going forward. If the Federal Reserve fails to hike at its 17th of September meeting, I think this could perhaps pave the way for a number of emerging market central banks cutting their policy rates and allowing a degree of currency weakness. Now, to be clear, I don't think that emerging market central banks will aggressively loosen policy. In particular, I think Asian currencies will remain reasonably well behaved as they have done year to date. But if the Fed does hike, whilst at the same time providing a reasonably dovish forward outlook, I think this strengthens the case for emerging central banks to keep rates steady. But I don't expect emerging market central banks to follow the Fed in hiking rates. I think only the SARB, the Brazilian Copom, and perhaps Bank Indonesia may buck this trend and get into lockstep with the Fed, hiking rates to support their currencies. So again, in conclusion, I think we've seen central banks in emerging markets being quite slow and reluctant to cut real policy rates, worried about what the Fed will be doing going forward. So if the Fed, for whatever reason that may be, decides in September that it's simply not time to hike rates, I think that central banks will see this as an opportunity to loosen monetary policy at the margin and provide some support to growth. In the following slides, I detailed the methodology that I've used in my charts, and I also go into specifics about the data variables that I have been using. I also list all of my previous emerging markets research, and you can find my entire back catalogue of research and more at my website, which is www.olivierdesbarres.co.uk. As always, I would welcome any comments or questions, and I thank you for your attention.